Welcome to the video on choosing between Roth and traditional accounts for high earners. Today we'll focus on why traditional contributions often win when your current marginal tax rate is high, how to think about future tax uncertainty, and which balance strategies can maximize long-term outcomes. We will also cover a practical decision framework and test your understanding with short quizzes. Let's begin. Here's our roadmap. First, we'll define the dilemma. Next, we'll examine why traditional contributions can be more efficient for those in high marginal tax brackets. Then, we'll address future tax uncertainty and how retirees can manage their effective tax rates. After that, we'll discuss balanced tax buckets and a clear action plan. Finally, we'll check your understanding with short quizzes and wrap with key takeaways. Now let's add a brief but important disclaimer. Before we proceed, remember this content is for educational purposes only. It is not tax, legal, or investment advice. Your specific situation may differ, and tax laws change. Please consult a qualified professional for personalized guidance. With that in mind, let's set the context for the Roth versus traditional decision. The fundamental trade-off is simple. Roth contributions are taxed now and withdrawn tax-free later, while traditional contributions reduce your taxable income today but create taxable withdrawals in retirement. For high earners, the critical factor is tax bracket efficiency and the progressive structure of the tax code. If you're paying a high marginal rate today, deferring that tax through traditional contributions can be powerful. Now, let's dig into why traditional often wins for those in the 32% and higher brackets. Traditional contributions can be superior for high earners due to tax bracket arbitrage. When your current marginal rate is 32% or higher, each dollar contributed to a traditional account avoids that high rate today. Over time, the money you didn't pay in taxes can stay invested and compound. In retirement, you have more levers. You can manage the timing and size of withdrawals, use the standard deduction, and fill lower tax brackets first. This often results in a lower lifetime effective tax rate compared to paying today's high marginal rate. Next, let's visualize a quick decision flow to make this more concrete. This flowchart begins by asking about your current marginal tax rate. If your marginal rate is 32% or higher, the chart guides you toward traditional contributions due to the immediate deductions value, with a reminder to add some Roth via backdoor strategies to diversify tax exposure. If your marginal rate is below 32%, it suggests considering Roth or a split approach. Additional notes highlight that retirement withdrawal control and standard deductions can keep effective rates lower in retirement, while future tax uncertainty is a factor but not the primary driver. The chart ends with a universal directive to save aggressively no matter what. Now let's discuss that uncertainty directly. While some argue for Roth to lock in today's tax rates against possible future hikes, disciplined retirees can often manage to lower effective tax rates using standard deductions and careful withdrawal timing. Roth accounts remain valuable, but primarily as part of a diversified tax approach rather than the default choice for those currently in high brackets. Uncertainty about policy changes exists, yet flexible planning, controlling withdrawals, and balancing account types provides resilience. To sharpen this, let's compare Roth and traditional features side by side. On the left, Roth contributions involve paying taxes today in exchange for tax-free qualified withdrawals later. They can hedge against future tax increases and are especially appealing when your current tax rate is relatively low. On the right, traditional contributions are deducted at your current marginal rate, which is advantageous when that rate is high. Withdrawals are taxable, but with proper planning, you can fill lower brackets first in retirement, achieving tax bracket arbitrage. Required minimum distributions apply to traditional accounts, while Roth IRAs currently do not. Moving on, let's look at the concept of tax buckets to understand balance. This pie chart illustrates the three key tax buckets: traditional pre-tax accounts, Roth after-tax accounts, and taxable brokerage accounts. For many high earners, the traditional bucket may be the largest due to the value of current deductions. A smaller but meaningful Roth bucket can be built over time via backdoor contributions or mega backdoor strategies. The taxable bucket adds flexibility for capital gains management and liquidity. The exact proportions vary by individual, but balance is the goal. Next, let's translate all of this into a concrete action plan. Here's a practical plan. First, maximize traditional 401k contributions to capture the immediate deduction. Second, add Roth exposure through a backdoor Roth IRA, or, if your plan allows, a mega backdoor Roth. Third, Maintain a taxable investment account for flexibility and liquidity. Fourth, plan for Roth conversions in years when your income is lower, such as early retirement or sabbaticals. Fifth, in retirement, use standard deductions and fill lower tax brackets first to optimize lifetime taxes. Finally, revisit the plan annually as your income, the law, and your goals change. To summarize the differences at a glance, let's review a quick table. This table summarizes core differences. Traditional 401k defers taxes and is most powerful when your current rate is high. Roth, often accessed via backdoor or mega backdoor for high earners, involves paying taxes now in exchange for tax-free qualified withdrawals later. Taxable brokerage accounts provide flexibility, including the ability to harvest gains or losses and manage income. Together, these form a diversified tax approach. Now, let's test your understanding with a short quiz. Quiz time. The question is, which situation most strongly favors traditional contributions for high earners? Option A. Current marginal rate is 12% and expected to be higher in retirement. Option B. Current marginal rate is 35% with potential to withdraw in lower brackets later. Option C. You expect massive tax hikes and want to lock in Roth at any cost. Option D. You dislike required minimum distributions and want to avoid them entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. When your current marginal rate is 35% and you have the flexibility to withdraw in lower brackets later, traditional contributions can be highly efficient. This leverages the difference between today's high marginal rate and tomorrow's lower effective rate. Now let's look at how this plays out across a typical financial timeline. This timeline illustrates how tax strategy can evolve. During high-earning years, maximizing traditional contributions captures deductions. In transition or gap years, Roth conversions can be efficient when income is temporarily lower. In early retirement, you can fill lower tax brackets and strategically convert some funds to Roth. At required minimum distribution age, coordinate withdrawals with Social Security and Medicare considerations. Finally, for legacy planning, Roth assets can be advantageous for heirs. Next, let's cover a few advanced moves that high earners should know. Advanced strategies include the backdoor Roth IRA, which involves a non-deductible IRA contribution followed by a Roth conversion, and the mega backdoor Roth for plans that permit after-tax 401k contributions and in-plan conversions. You can also pursue opportunistic Roth conversions in years when your income is low. Asset location can improve after-tax returns by placing tax-inefficient assets in tax-advantaged accounts. In taxable accounts, tax loss harvesting can offset gains or income. With that in mind, let's move to one more quick quiz. Second quiz question. What best describes tax bracket arbitrage? Option A. Making frequent trades to exploit market volatility. Option B. Paying taxes now and later to average your tax rate. Option C. Deferring income at a high rate now, then withdrawing at a lower effective rate later. Option D. Only contributing to Roth accounts to avoid required minimum distributions. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Tax bracket arbitrage leverages the difference between a high current marginal rate and a lower future effective rate through careful withdrawal and conversion planning. Now, to solidify the main ideas, let's capture the key takeaways. These are the essential points. When your current marginal rate is 32% or higher, traditional contributions often provide the best immediate tax advantage. Over time, balance your tax exposure using a mix of traditional, Roth, and taxable accounts. In retirement, manage withdrawals to fill lower brackets. Build Roth exposure via backdoor routes when appropriate. And above all, prioritize saving aggressively. Your contribution rate is the most critical lever. Before we close, let's summarize succinctly. In summary, traditional contributions often beat Roth for high earners thanks to tax bracket arbitrage. Roth accounts still matter and can be built through backdoor strategies. Controlling withdrawals and using standard deductions can reduce lifetime taxes. Most importantly, save aggressively and let compounding work over time. To conclude, here's a creative send-off. Thanks for watching. If you found this helpful, please like the video, share it with someone who could benefit, and subscribe for more practical, research-driven financial content. Share your thoughts, questions, and strategies in the comments so we can all learn together. See you in the next video.